Good morning and welcome to this Wednesday, August 11th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we got futures actually moving up decent today. The CPI report for July came out just a little bit ago, and it wasn't a low number, but the good news is it wasn't a high number. And I think the market this morning, the futures are suggesting that got a lot of folks looking at the market as a glass half full as opposed to half empty. So we got a pretty nice reaction this morning. And I got an interesting chart I'm going to show you here in a couple minutes, looking at growth stocks versus value stocks. And it's almost been like almost an opposite effect. Like when rates have been moving higher, obviously growth stocks have been getting hit and vice versa. And so I think that a lot of us are trained now to think that when rates go up, growth stocks are going to get hit. And I don't know that that's necessarily going to be the case. It's going to be really interesting to see, but I think that there is more fear about the inflation side. I think, and that was the folks that were thinking that rates were going to go higher and be problematic, I think were mostly in the camp that inflation was going to be a big problem. And I think as we go through this, and we'll talk some more about this and as we go through the show, but I feel like this is going to be a situation where growth stocks continue to do well even when interest rates go up, because I don't think interest rates are going to soar. But I do think that they'll go higher as a result of better economic strength. As we see our economy strengthen, we see global markets strengthen. I think we're going to continue to see the yields rise, but I don't think it's going to be the fear of inflation that drives that. And so the growth, if you've been watching the earnings reports coming out this quarter, some of these numbers, they're spectacular. And this growth rate, unfortunately, is not going to continue. And so I do think that we're going to run into a difficulty. I've mentioned this recently, but I think the more I look at this, the more I believe we'll run into difficulties in 2022 at some point, because the comps are going to be very difficult. You're going to have a lot of these companies that are going to have projections of growth going forward that's probably not going to be sustainable. And when they start having to cut those a little bit, I think that could create a problem, but I don't think that's going to hit until next year. I think we're going to probably continue to sail throughout this year. Maybe we'll have a small pullback. Perhaps it's in August or September, but anyhow, a lot of that, I'm going to talk about all that in just a couple minutes. But first, let me take you all over to Earnings Beats. Those of you who are new, just want to point out that, we do have a free newsletter. If you go to earningsbeats.com and you want to subscribe to our free newsletter, just scroll down and type in your name, email address in the area provided, hit that subscribe button. We do publish an article 3 times a week, Mondays, Wednesdays, and Fridays, typically out before the stock market opens. It's a free newsletter, no credit card required. You can unsubscribe at any time. Love to have you in our community there. Moving on to the action that took place on Tuesday, the Dow Jones set a new all-time high, 35,264. It was up 162 points. The S&P 500 at 4436, right there you can see intraday set a new high. On a closing basis, we were close. I didn't look to see, but it's very close to what we saw, I think, on Friday last week at the close. The NASDAQ saw weakness in the afternoon. I think there were, and really throughout the day, the group started out okay. The tech-laden NASDAQ did pretty well at the opening bell, but then we saw a lot of technology stocks, communication stocks, the consumer discretionary. Many of the growth names got hit during the day. We saw money rotating more toward financials and industrials and so forth. I think some of that had to do with this inflation report that was coming out this morning. And we got another one out tomorrow morning, by the way. So we got consumer inflation data today, out today. Tomorrow is the data having to do with the producer price. So you got the PPI tomorrow. CPI was today. So still got some inflation reports that we're going to have to deal with. We'll see what happens tomorrow morning there. But immediately this morning, I thought the futures turned much more in favor of those technology names when we saw that inflation was not a runaway. If you recall back in the June CPI report, which was reported or released in July, that report was showing an actual number that came in well above expectations. I think it was right around the 1% level when the expectation was closer to 0.5%. So I think market participants were a little nervous going into this report with the expectation at 0.5% again. This time we hit it. Actually, on the core level, we were a little bit lower. I'll give you those numbers when we look at the 10-year Treasury yield in just a second. But anyhow, I think that was what was driving the market a little bit yesterday afternoon and throughout the day. I think there was a little transition away from some of those technology names because of fear that inflation was going to rear its ugly head again. Mid caps, small caps, you can see both actually outperformed yesterday. Small caps, the best performer on a relative basis. Also, not to be lost here is the fact that this small cap index, for the first time in about a month, closed above its 50-day moving average. Now, it was only 2 points, but we did see it close back above that 50-day moving average for the first time since in the first week of July. So that was good news. Energy, materials, financials, industrials. Those were leading. Now, if you look at their charts over the last 2 months, you'll see that these were the groups that were out of favor. And now they're coming back into favor. Now, whether or not that lasts, considering that the inflation report wasn't what some were thinking, that remains to be seen. We'll see what happens after the opening bell today. But those 4 groups clearly were the groups that were favored yesterday. Real estate, which had been moving higher, actually pulled back. And this is honestly what we've been dealing with throughout 2021. It's this constant rotation, which is good news for a bull market, because when leaders start selling off, it doesn't take the market down. The money just simply rotates and goes over into another area. So right when technology and some of those growth names took a hit yesterday, then we had the financials and many of the value, reopening stocks coming back in. You had energy returning, materials, a big breakout yesterday on that daily chart. So the money continues to rotate. This is really good news for the bull market. All right, the 10-year Treasury yield. Let me update this for you, make sure we get the latest. So right now it is at 1.35. It's up a little bit more than 1 basis point. Trying to extend its 6-day or 5-day winning streak. This would be the 6th day if it can finish higher today. So we'll see if it does. This is absolutely enabled financials to regain their strength. You can see this down at the bottom. But for me, I think a lot of this today is about the inflation coming in as expected. This is the first time in a while. I wanted to show you another chart, which I'll get into here in just a second, with the growth versus value, and then also take a look at a long-term chart on inflation and see why. I want to show you why folks are a little nervous about inflation right now. But I think in the short term, I'm looking for this 140, 142 area. We got the 50-day moving average coming in now at 138. You got the prior high in July, that reaction high getting up just above that 140 level. Let's see if we can get up to that level. If we get through and start printing 143, 144, then it would start to suggest this entire downtrend has been broken and we're starting to trend back up, which would be very good news in the intermediate term for these financial stocks that are starting to rebound. Watch that 10-year Treasury yield. There's a very, very strong positive correlation between the direction of the Treasury yield, the 10-year Treasury yield, and the direction of the relative strength of financials. This chart down here is the relative strength of financials versus the S&P 500. So when you get the yield going down, you can see how money rotates away from financials. When we start to move back up, you can see the money coming right back into financials. So you got to keep an eye on the Treasury yield in terms of deciding whether to overweight or underweight your financial side. All right, so let's move on. Let's talk a little bit about this growth versus value, because I think this has been kind of the wild card in 2021. I mean, it's been extremely volatile. And what I have here at the top is the Dow Jones US Small Cap Growth Index versus the Dow Jones US Small Cap Value Index. So it's both are small cap, but it's growth versus value. And as you look at the 10-year Treasury yield here at the bottom, you see how we started accelerating to the upside. And this is when inflation data started coming out strong. And again, I'll show you this in just a minute. But as you see this yield start to turn higher, look at the growth stocks getting hammered versus value. We went through two of these. But notice the last time when we came out with that, I think it was the April CPI, came out around May the 13th, I want to say. It was right in here near the bottom. You can see where a lot of folks were getting out of growth stocks this time before the report came out. But once the report came out, we bottomed and we've been trending higher. And as we've been trending higher, the yield's been going lower. So what happened? Did inflation just go away? I mean, if you look at the monthly reports, it didn't go away. But I think what the market has been telling us is that the market is not worried about inflation. And so as the yield started dropping, I mean, there's no reason, if you thought that we were going to have a real inflation problem, yield should not be going down. You wouldn't see yields going down. Folks would be getting out of bonds, yields would be going higher. No reason to jump into bonds if you think there's an inflation problem. I mean, that is not a good place to be. Stock's not a good place to be either. And yet we've seen money rotating into both while this supposed inflation fear is out there. I honestly, based on, again, I don't like listening to the media. I like listening to the charts and listening to the story that the charts are telling me. The charts are telling me inflation is not a problem. And so the question I have is, okay, how quickly are we going to accelerate in terms of economic growth? And what impact is that going to have with interest rates? And can growth stocks outperform value while these interest rates are rising without the inflationary fear? I think the worst of the inflationary fears are behind us, or kind of, we're going through the end of it right now. I think as we move toward the end of the year, I think a lot of these inflation reports are going to start to come back down. And so what yields do going forward and what this ratio does right here going forward, I think is going to play a big role in how you want to put together your portfolio. Now, I want to show you the inflation. So what I've done is I've recorded, this is a monthly chart of the consumer price index, the core CPI. So this isn't just the headline, this is the core number. Now, a couple of things you have to understand about this. First of all, back during the pandemic, you can see we went down 3 months in a row in this reading. Now, over the last 20 years, you can probably pick out just maybe on one hand, actually don't even need one hand. Here we went down during the financial crisis. Here, coming out of the financial crisis, we went down one time. And here, you might not be able to see it on your screen, but these are just little red blips where CPI, core CPI actually was below zero 3 times in 18 or 19 years. And then in 2020, it went down three months in a row. So as the economy has strengthened and as demand has picked up, supply hasn't been there. So we've had this bubble going through our economic cycle where demand has just been exploding and there's not enough supply. And look at the jumps that we're seeing in the CPI, the core CPI. Just like we had never seen 3 drops in a row, we had never seen 4 massive increases like this in a row. I mean, go back over the last 20 years. So this is what's been spooking the market. And if you look at this down at the bottom, I have a rate of change. It's a 12-month rate of change. So it gives you basically the annual inflation rate on the core CPI. And you can see that for 20 years, the highest we ever were was 3%. We're at 4.45%. And that's not even including what we had this morning. So this number is going to continue to rise. What the Fed has been saying, and I completely agree, is that this is a short-term transitory situation where we're not going to see inflation. This is because of the pandemic. It's because of the increased demand and the relative lack of supply. And that's what's driving inflation higher. And so as we see the CPI numbers. The headline numbers look horrible. But I think what we're going to see is probably at this point, sometime next year, I wouldn't be surprised to see a little red again, because what's going to happen is everyone's ramping up production. Everybody's getting back to work. The unemployment rate, I should say, is going down. More and more people are back to work. We're producing more goods. And then next year, the demand, we're not going to be coming out of a pandemic. We're going to already be out of the pandemic. So I think when you start looking at next year versus this year, you're not going to see those kinds of price increases. So I think all of a sudden, you're going to see CPI start to move back down and inflation going back down to the Fed's target levels. That's why they're not going to be pressured to raise interest rates. Strong growth alone does not you don't raise interest rates just because of growth. What you have to watch is whether or not the growth is such that it overheats to create inflation. And then the Fed will act to stabilize prices. So you got to understand how it all is coming together. I think next year we're going to see this CPI number come back down, or at least flatten for a period of time. And I don't believe inflation is going to be a problem at all. Anyway, that's just my take on it. All right, let's move on to, I want to look at the relative strength. We haven't done this in a while, and I tell you, the numbers or the rotation, it's just been the wackiest I've ever seen. And I've been trading a long time. I've just never seen the money. I've seen rotation. Rotation's normal. But the quickness and severity of it, it's like, literally you got a group that's on fire and 2 days later can't catch a bid. And so we've seen a lot of this back and forth. You can see technology kind of showing that ever since we had that huge move up throughout the pandemic with technology leading the S&P 500. Since then, it's just been this choppiness. Technology hasn't been bad, but you got to know when to be in and when to be out. I mean, we've had some bad drops. We saw that back in February, March, and then again, April, May. But then when the inflation news was at its worst back in May, June, July, you saw technology stocks moving back up. This shouldn't happen in an inflationary environment. This is another one. It's another piece of the story that's telling me don't worry about inflation. Technology stocks should not be going up like this on a relative basis in an inflationary period. Inflation eats away at those future earnings. So growth stocks tend to get hit the hardest during inflationary scares and periods. We saw the hit, but then we saw the group come right back. Again, if this was an inflation problem going forward, we would not have come back. Technology would have continued going lower and lower. So I think it's really important to, again, understand the story, what the stock market is telling us, and ignore what the media is telling us. Part of the problem, and I'm not trying to pick on the media. What I'm saying, though, is you've got investment firms who have analysts who talk to media, and then you've got the other side of those firms that are trying, are deciding whether to buy or sell and what they're going to do for their clients. I think it behooves these analysts to come out and talk up inflation and talk up the scares, that the possible scares that are out there, because it gets them cheaper prices. Why wouldn't you? I mean, I'm not saying that they're out there lying, but they're talking about fears that they probably aren't themselves preparing for. Just my opinion. When I look at the charts and I see technology going up on a relative basis, but then I hear all the inflation reports and different analysts coming out and talking about how inflation is going to be a problem and lowering their target on the S&P 500, and makes me scratch my head and wonder exactly what's going on behind the scenes. I mean, I don't think Wall Street is the most trustworthy bunch. I don't know. That's just my opinion. A lot of money at stake. Anytime you have a lot of money at stake, you got to worry a little bit about what people are saying and whether or not they're really doing what they're saying. So anyway, I think technology here continues to look pretty strong. It's just, are we going to have another one of these pullbacks? Now, consumer discretionary has not been nearly as strong. We got a lot of industry groups within consumer discretionary I want to take a look at here in just a second. But this group, topped back in February, and it's been drifting lower, and it's back below its 20-week relative 20-week EMA, which is below its 50. We've still got the relative PPO in negative territory, even though it's been trying to strengthen a little bit. I don't know that consumer discretionary is going to be a bad group, but it's just not showing us leadership right now. And as much as I want consumer discretionary to do well, because I am a fan of consumer discretionary going forward, right now the chart's telling me we still have to be patient for the group. There are areas that are doing okay and doing well. I mean, footwear been on fire, but most of the groups within consumer discretionary have not really performed well. So if you've got a number of consumer discretionary stocks and you're lagging, that may be part of the problem. But we'll go through the industry groups just a minute. I just want to go through these sector relative strength charts first. So communication services, I think the uptrend's still intact. We've seen a little weakness here in the past few weeks, but overall this uptrend looks pretty good still. Industrials, the yield has definitely hurt. I think that there's still a little concern that maybe the economy is not going to be as strong as the Fed is forecast. I think those fears are unjustified. I think we're going to have a very strong economy going forward. But, you know, you got the resurgence of COVID, the Delta variant and so forth. There's a lot of things that are maybe driving thoughts that the economy won't be as strong. And as a result, transportation stocks have been one of the worst areas of the market since May. And I'll come right back to this chart, but if we just pull up transports, you know, just so you can get an idea of what I'm talking about, it's been really bad. We did yesterday finally get back up above the 20-day. So that might be a start, but since May, this has been going down. Now I want you to look at the industrials relative strength since May. It's all the transports. So as the transports start to turn back up again, the yields begin to pick back up again, the rhetoric about the economy slowing, you know, once that starts to fade, I think we'll see industrials turn back up again. It's a little riskier to jump into industrials after they've been showing a lot of relative weakness, because you don't know if this is where it's going to turn. Are we going to continue trending lower? But I do believe industrials will do well. I think we're going to get that rotation back into the industrials, pretty much like we saw at the end of last year when the industrials took a hit for 2 or 3 months and then came roaring back. I expect we're going to see that, and it could be just starting. I mean, who knows? But a lot of the stories I think that have shaped the recent relative weakness, I don't think they're justified. So I expect industrials to come roaring back. Financials have already started coming back, and that's going to have a lot to do with the yields. But if we don't have an inflation problem and the economy is strong and the yields go up a little bit, this should be one of your leading groups. Now, financials normally aren't the best group, but you want financials going along for the ride. You at least want financials going sideways on a relative basis. When they're leading, that's awesome, because financials are home to banks, among other industry groups. And if banks are outperforming, it means Wall Street likes their numbers. And if they like their numbers, that means they're probably going to be in a great lending mood. And believe it or not, we are a borrowing society here in the US. We like to borrow. And that's how we achieve a lot of our growth. That's how many of the small cap companies are able to grow their business. It's through being able to borrow. So if banks are doing well, the tendency is to lend, which helps the economy continue to grow. So anyhow, financials you want to kind of keep an eye on. As long as the yields, you know, are turning back up and we're not going back down to that 1% or 1.2% area, then this relative weakness should be over. I would be looking for financials to perform well. Healthcare is starting to strengthen. And now we're back over the 50-day or 50-week on a relative basis. That relative PPO has just turned positive for the first time in over a year. This is all good news. So I think healthcare continues to strengthen. I think this is a group that's fine right now. Staples, now we're getting into the defensive groups. Once again, this is part of the story that I look to. If inflation's a problem, not only would we be seeing a sell-off in the stock market, but we would see money rotating heavily towards defensive areas. Consumer staples should be strengthening considerably, and we're not. But if you look at the absolute chart, staples are fine. We're going higher. It's just that they're not going higher as fast as the overall S&P 500. So when you're looking at these relative charts, don't look at this and say, oh my gosh, consumer staples is losing so much money. No, they're not. They're going up. They're participating. They're just not going up as fast. Real estate has been one exception within the defensive groups. And I'm sure, having historically low interest rates isn't hurting this group. So real estate moving higher. I think the overall trend still is good, but you can see the long-term trend is down. So I don't know if real estate has run its course, but I don't expect real estate to be a major leader in the market going forward. Utilities look a lot to me like consumer staples. And once again, on an absolute basis, we just broke above 67 on the XLU. We just cleared a double top. So we got a breakout. Utilities on an absolute chart, if you didn't know anything else about the stock market, you'd say, hey, we just got a breakout. This is great. But then you look at the relative strength and you say, okay, this isn't an area where I really want to be focused. Energy and materials are just two unique areas. And I just call them my neutral sectors, because they can lead a bull market, they can lag a bull market. It doesn't matter what interest rates are doing. They are tied a lot. Obviously, energy is going to be tied a lot to what's going on with crude oil price, but it's also tied a lot to the dollar, to the US dollar. When the dollar is strong, energy tends to be weak on a relative basis. Same goes for materials. And that's why if you look back over the last 8 years, you'll see energy and materials downtrending versus the S&P 500. Now, over the course of the last year or so, the dollar was weak and energy actually regained its footing. And if we look at materials, you'll see materials actually did very well while the dollar was weak. I think I might have, here's a dollar chart. See how the dollar down here was going down and relative strength in materials was going up. And then when we reached the bottom and the dollar started rebounding, and by the way, the dollar just hit about a 10-month high over 93 in the dollar index. Look at the relative strength in materials. So watch the dollar, because if the dollar continues to strengthen, I'm not sure you're going to see that relative strength that we've just seen recently in materials. I don't think it continues. I think we roll back over again. All right, let's take a look at the relative strength industries. I just want to go through the consumer discretionary. I'm going to do it very quickly, just to give you a sense of what's going on in consumer discretionary. Hotels trending lower. Again, this is a relative chart to the S&P 500. Toys, just awful. Restaurants, they turned up, but now they've turned back down. Specialized consumer services trending lower. Clothing and accessories. This is a group that I've been looking for, reopening stocks. You'd think some of these stocks maybe would do a little bit better. They've strengthened, but they're still, I wouldn't exactly say they're leaders. And they are moving up, by the way. Here's the absolute chart. But on a relative basis, got a little bit of a downtrend this year, which is a little surprising to me. Home improvements all over the place, but right now, currently under the moving averages, not looking particularly good. You can see that relative PPO is negative. Recreational services, not a fan. I mean, we had that huge, massive decline when the pandemic first hit. Yeah, we've been rebounding, but we're nowhere near where we were on a relative basis before the pandemic. And we've had a pretty big hit to the downside over the last couple of months with the whole COVID variant surging again. Apparel retail, kind of like clothing and accessories, pulled back. Now we're starting to strengthen again, but not really getting a lot of strength. I mean, as you go through all these charts, you can understand why consumer discretionary is not doing well. Specialty retail, under pressure on a relative basis. Travel and tourism, once again, that COVID variant really providing some headwinds for that group. Gambling, same thing. Look, gambling was really strong. Almost got back to that pre-COVID level and then completely fell apart again. Gambling stocks, I would expect they've probably been oversold on a relative basis. They'll probably pick back up again, but not a great looking group. Then you got your home construction. This has actually been one of the better groups, and with rates still low, this one's held up pretty well. Broadline retail, nope. Thought we were going to finally get that lift with Amazon. Then they reported earnings, right back down. Amazon went right back down. Broadline retail went. Furnishings has been one of the bright spots. So this has been an area that I think still looks pretty good. We were very overbought on a relative basis, and we pulled back the last few months. I think that could be creating some opportunities here. Footwear has been one of the best. I mean, there's no doubt. We had Nike come out, Crocs come out, Skechers come out. I mean, so many of these leading stocks in footwear came out with great numbers, and you can see just absolutely exploded. So this is one of the best areas in the market still. Then you got business training and employment agencies. As the economy's been strengthening, this group's been doing better. Durable household products weakening these last 3 months. So we had a really good run, and now they've kind of fallen apart, and we're back near almost a 1-year relative low. Autos starting to strengthen, trying to strengthen. This is a group that could really help the XLY, because one of its main components, Tesla, is the second largest holding of the XLY, and Tesla's been showing some strength, getting through 700 recently. So I think this one could be starting to turn back up again. This one's worth watching. Recreational products has been pretty strong, pulled back, little relative weakness here for a while, starting to turn back up again. I think this one looks pretty good. And then the last one, auto parts, was strong. It's pulled back. You can see that relative PPO has gone negative. But as we go through these various industry groups within consumer discretionary, you can see how the majority are just not doing well. And that's been a problem for the overall group. All right, let's see. We just opened in the market. So I tell you what, we've got earnings. I'm going to take 3. There were not really a lot of big names coming out. So I thought what I would do is maybe just give you these 3 as the 3 you must see, and we'll wrap up. First one, a big one that came out yesterday was Coinbase. So as we pull up Coin, I'll give you the number. The market was expecting $2.49. They came out with $6.42. When I was talking earlier about earnings growth being unsustainable, this is what I'm kind of referring to. What company comes out and beats their earnings by $4, $2.49 versus $6.42? And the stock's up 6.5% today. Probably should be based on these numbers. And my guess is it probably is going to continue. I mean, it's got a nice run going. It's overbought. But this is a stock with that kind of an earnings beat, growth rates going forward, likely to be adjusted higher, valuation likely to be adjusted higher as well. So I expect the stock to continue to do well. The next one up, how about Unity Software? U is the ticker. And this is a company that beat also. They were expected to lose 12 cents. They lost 2 cents. That's a 10-cent beat. And nice reaction here. Stock up 7%, threatening to take out these prior highs. Very good move on Unity Software. And then the last one, let's take a look. I know this company, I think I saw in the headlines, was doing pretty well. Upstart, UPST, another huge gap higher, expected to earn 24 cents. They earned 62 cents. I keep going over and over and over this one point. I want to keep hammering it home. Ignore PE ratios. And if you're a fundamentalist, it's hard to even think about that. But when you're in a secular bull market, prices continue going higher, and the earnings don't get adjusted until each quarter has passed. So you get price action that's going up in anticipation for earnings season. And that drives these PE ratios. And anyone who's a fundamentalist who wants to look back and say, well, yeah, but in 2000, the PE ratios were 30, and that marked a major high. And what they don't tell you is that the PE ratios in 95, 96, 97, 98, 99, all of them were way over normal. But the market kept going up, and the PE ratio was stabilizing because earnings kept going higher, the other half of the ratio. Those that follow the PE ratio only look at price. They look at the S&P 500 and say, wow, it's going up. The PE ratio is high. It can't go up anymore. Well, when you see companies like Coinbase reporting earnings of $6.42 instead of the $2.49 that was projected, you can kind of begin to see why these PE ratios don't matter. Anyway, I'm going to leave you with that. Let's take a quick look at what the market is doing right now. There we go. So Dow, S&P, NASDAQ, all up about 1/3 of 1% roughly. Small caps, mid caps getting hit a little bit. My guess is we're probably seeing a little bit of weakness in energy and materials. We can pull that up real quick too, and then we'll wrap this up. Yeah, energy down at the bottom there, not a surprise. Technology back at the top. So yesterday, all those that were selling technology ahead of the inflation report, all of a sudden say, well, inflation is not that bad. You know, it's not higher than expected. So they're jumping back into some of those positions. All right, that's it for me. Everybody have a great day. I'll be back tomorrow over at Stock Charts TV, where you can find me at 9 a.m. tomorrow. Just click on Stock Charts TV at 9 a.m. That'll be the next Trading Places Live. Of course, it will be my recorded version, but I'd love to have you supporting me over at Stock Charts TV. So everybody have a great day. Hopefully see you over there tomorrow. Happy trading.